So we had a pretty big week in mortgages. The Federal Housing Administration gave probably one of the coolest announcements I've heard in a very long time, but they are now extending FHA financing to anyone with deferred action status, also known as DACA. Now I'm going to post 2 previous videos that I recorded on what that is and how it impacts the economy. Clearly from watching those videos, you're gonna know that I'm very pro DACA and I'm excited about this new change. And so I wanted to make today's video about loan options, right? What it means for you as a first-time homebuyer to know the difference between FHA financing, conventional financing, what the big differences are between the two. And then I also wanted to give you some key questions to ask your loan officer if you are in the process of shopping for a home loan. Now, before I get into all of that, I'm gonna ask you to like, comment, and subscribe and share this video with a friend who might find this information helpful. So I realize that some of you are new to the channel, so brief intro. My name is Lizzie Hofer. I've been a residential loan officer in Phoenix, Arizona, and I've worked in mortgage finance for the last 17 years. I have seen a variety of different markets and have very strong opinions on home ownership because I was raised by a single mom who had to work 2 jobs to pay our mortgage. So I definitely have lived in house poor situations. I educate buyers all the time on budgeting, on money, and I will tell you that owning a home for my family meant getting out of poverty, understanding debts, understanding the impact of a budget, of a monthly housing payment, interest. It taught me so much. And so I am personally very passionate about sharing that same information with you so that you guys can become super successful homeowners. Okay, so I want to talk about why this change is so impactful. So I don't think people really realize the importance of having a very healthy percentage of first-time homebuyers enter into the market. And we've literally had a historically low percentage for nearly 20 years now. It's why it's taken us so long to recover from the Great Recession. And yes, there's a variety of reasons for that, like higher interest rates, crazy student loan debt, low incomes. There's a lot of reasons for that, but we're now in an environment with historically low interest rates, increasing incomes, and honestly, millennials are now in their 30s, they have more assets and more disposable income, and we now have had those long student loan deferrals. So I just think that there is just so much opportunity now, even though it is a very competitive real estate market. There's gonna be so many benefits to the economy to have a larger percentage of first-time homebuyers. Now, the reason for that is because think of how many industries are positively impacted by somebody purchasing a home. They instantaneously want to make it their own, they're gonna paint it, they're gonna furnish it, they're gonna get their own utilities, right? They're gonna get people to help them maintain it. So if you think about it, it's like home furnishing, appliances, utilities, home construction, home maintenance, real estate agents, mortgages, bankers. There's so many different people that actually benefit and so many different industries that actually benefit. So a healthy percentage of first-time homebuyers, right, entering into this market is just going to be so crucial for our overall economic recovery. All right, so what loan options are available to you? So if you're a buyer buying in 2021, what do you need to know in terms of your financing options? Well, first and foremost, I want you to know that there are down payment assistance programs, zero down programs that you can qualify for. A couple of them are going to be like your CRA funds from big banks. So you'll want to ask, it's called community reinvestment funds, down payment assistance programs or municipal grants. All of those are going to be dependent on area median income, debt to income ratio, and then bank thresholds. Then if you're a qualified veteran, there are zero down programs. And if you're buying in a rural area, again, there are zero down programs for you. Now, what I want to really discuss here though is conventional versus FHA, because if you look at the data from last year, 76% of first-time homebuyers are using those programs to purchase their homes, and they're putting anywhere between 3 and 5% down. So let's kick this off with understanding what options are available for FHA, right? What do you need to know? Well, first and foremost, minimum down payment is 3.5%. And depending on where you live in the country, there will be a loan limit that you need to be aware of. In Maricopa County, that's $368,000, right? But our whole state has different loan limits. And so you'll just want to know For the majority of the country, it's a floor, but there are places where there's high balance. And so you just want to know that you are going to be looking for your loan limit, right? At 3.5% down. Your minimum credit score requirement is a 580. You will pay mortgage insurance in an upfront finance premium and in a monthly premium, and it is for the life of the loan. So the entire time that you have this loan. Also, it's only available for primary residences. Now, why would somebody want to qualify for an FHA loan? Well, the reason is it's created for people that are maybe not as credit qualified or income qualified as other borrowers. It was created in 1930s to, just supply people with affordable housing, specifically for first-time home buyers. So things that I like about FHA is one, they allow for more flexible credit guidelines. Look, we're not perfect, things happen. And if you were somebody that had any credit challenges, this is a perfect program for you. It also allows for financing for people who maybe don't want to use credit at all and can verify rental payments and utility payments. If you can prove positive alternative trade lines, again, FHA is a great program for you. It's also really great for people that have income that they can't necessarily document, whether it's from like a non-borrowing spouse or they haven't earned commission or bonus income for long enough, right? So it allows for higher debt to income ratios, up to 57%. So, it's a really great program for people who need flexibility. I will also say that if you have anything under than a 680 credit score, in my experience, FHA seems to be the more affordable loan program because of interest rate and mortgage insurance. But again, you're going to want to compare that to your conventional. That's just what I'm seeing, and that's anecdotal advice, right? So I just want you guys to know. Now on conventional, you guys need to know minimum down payment is 3%, but it will come with higher mortgage insurance than what you would see on an FHA loan unless you have super great credit. Now, credit on conventional loans is tiered. It technically goes down as low as 620, but here's the thing. When I say technically, you have to run every conventional loan through an automated system that'll either say approve eligible or accept. And if it doesn't say that, then we can't provide you with that type of financing. So I just want you to know, it technically has a 620 credit score, but really it's rare that I see those getting accepted with minimum down. So just know that your mortgage insurance and your interest rates are gonna be tiered based on your credit. And I will tell you that if you have under a 680 credit score, you definitely wanna compare this to FHA, right? You really start seeing your credit breaks with, it goes like 680 to 700, then 701 to 719, then 720 to 739, and then 740 and above, it gets you your best type of financing. There is also a pretty big difference in mortgage insurance between 3 and 5%, so you always want to compare those. Things I like about conventional loans, well, one, in this marketplace where it's super competitive, conventional loans actually have a better chance of getting your offer accepted. Again, this is anecdotal, but I will tell you that that's what it feels like. Also, they have, I would say, more flexible requirements for appraisals in terms of necessary repairs that need to be done. Also property types, you can finance more condos easier, townhomes. They have a higher loan limit, right? The loan limit's $542,000 or $548,250, right? So you just have a lot more options available, but you do have to be a stronger credit borrower to qualify for conventional. All right, so now that we've gone over the basics of the loan programs, I'm gonna tell you about things that you really need to know to ask your loan officer when shopping these loan programs. So first and foremost, you should always ask your loan officer to provide at minimum 3 different loan structures for your potential purchase. I would always do an FHA versus a 5% versus a 3%. And then once you've chosen the right program, I would then ask them if there's any ways to actually improve the monthly payment through either buying down the interest rate or buying down mortgage insurance, or see if there's any ways to make your offer more competitive, right? Are there ways to do a credit to minimize costs? And I would always have them compare these options based on the length of time you plan on being in the property. Okay, so if you're a first-time homebuyer, just know that the average first-time homebuyer lives in a property anywhere between 3 and 7 years, depending on where they are in their life cycle. You know, the longest period we see people live is about 10 years. So I probably wouldn't do anything longer than a 10-year period. And also you want to consider like variables, right? Are you going to want to do a cash out refinance later on? Are you going to want to finance and put somebody else onto the home loan later? Is this going to be a future investment property? These are all variables that you want to talk about to your loan officer. Now, other things that you want to be aware of, right? A loan officer who doesn't want to do multiple scenarios for you. I have this pushback all the time from people who say, well, I couldn't get him to do multiple scenarios. Would you run more scenarios for me? And I will tell you that you need to look at the options because I promise you they're so different. And you know, the majority of people, they'll call in and they'll just give you whatever you called about. If you called about a $250,000 house, they're going to give you a $250,000 pre-qual, right? A 30-year fix versus a 15-year fix, like they don't really care. They're just going to give you whatever you called for. So comparing these things allows for you to make an educated decision. Also, you have to be an advocate for how they structure your loan based on mortgage insurance and buying down interest rates. A lot of times people, when you say you want the lowest payment option, they assume interest rate, and buying down your interest rate can be super costly and it rarely ever pencils out. It's actually one of my biggest pet peeves when it comes to sales and mortgage. The other thing that I literally hate, and this is like probably the thing that drives me the most nuts, is when I hear people say, well, don't worry about it. You can just refinance in 6 months to a year. Well, one, we're not psychics. I don't know what's going to happen 6 months to a year from now, if interest rates are still going to be historically low, if the market is going to be appreciating to this effect. I personally believe that you should try to get the best mortgage structure the very first time, paying the least amount of fees and making sure that it breaks even over time. And so a lot of times I don't recommend buying down points, or I don't recommend buying down mortgage insurance if this isn't going to be a home that you plan on living in for a long time. Now, that's obviously going to be case by case, but unless you are comparing your loan options, how would you know? So just know that those are things you want to do. And one more caveat about refinancing: unless your refi saves you at least $200 a month or 1% in interest, it's not worth doing it because you're just losing a little bit of your equity over and over and over again. And these salespeople are so good because they know that people want the lower interest rates for bragging rights. It makes them feel good. But honestly, it shouldn't be at the expense of your home equity. You will care later on, I promise you. So if you got anything out of today's video, here's what I want it to be. You have so many options for being a first-time homebuyer when it comes to low down payment options, and you should be excited about what it does for the economy, what it does for your wealth trajectory, and do not miss out on an opportunity because you don't have 20% in down payment funds, right? So I just want you to know there's a lot of great affordable options to help you along. Yes, it's a very competitive time to buy, but still, if your budget says it's ready, like I've preached, then do it. Take the plunge. All right, if you guys have any questions at all on financing, on whether or not it's a good time to buy, interest rates, payments, anything that I talked about in this video, I would love to hear them. Please go ahead and comment, and we'll put them in another FAQ video. And guys, don't forget to like, comment, and subscribe because you don't want to miss a money tip in the future.